is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance. This is the Early Edition. I'm Danny Berger in London, in for Francine. Here's what's coming up on today's program. French inflation slows for the first time in 3 months, but still comes in marginally hotter than expected. Eurozone CPI hits later this morning ahead of the key print from the U.S. Donald Trump has been charged with allegedly paying hush money to a porn star and will be asked to enter a plea as early as Tuesday, his lawyers say. The 45th president calls the action political persecution. Plus, China's recovery of the economy gathers momentum, with manufacturing, services, and construction topping forecasts in March. It's perhaps a boring end to the month, to the quarter, to the week, and what has been anything but boring. Equity futures in the U.S. able to only just barely notch 0.03% higher. We are on track for a gain of 2.5% for the totality of the month. Shocking when you think everything that's happened, and yet stocks are set to gain. Some weakness coming through for the euro, down 0.2%. I mentioned we had French inflation data. It came in slower, but as inflation really vanquished, still have the hawks out in full force over at the ECB. That perhaps is why we're seeing a German two-year yield moving higher, about 6 basis points. U.S. two-year yields, they're moving higher by 3 basis points, but that belies what's happened this month. The two-year yield, that has fallen 75 basis points through the rest of March. When it comes to equities in Europe, we're still fighting for gains. Most of the map is gray, which means barely a move. One of the sectors, one of the industries and regions that are performing, it is France, it is luxury. It is those companies tied to China, considering we had really strong China data out this morning. Meanwhile, the banking sector is the worst performing today, hence why the FTSE MIB is falling in Italy, of course, high concentration of banks. Now, perhaps part of the reason investors are on the sidelines, it's the month end, but it's also inflation day on both sides of the Atlantic. French inflation has eased for the first time in 3 months, following a slowdown in other Eurozone economies. And now investors are awaiting the Fed's preferred inflation gauge, February PCE data. That will come out later today. Bloomberg Economics reckons Powell's super core indicator, core PCE services, excluding housing, will likely show little disinflation last month. Let's get to our guest this morning. It's Mark Haefele, Chief Investment Officer at UBS Global Wealth Management. Mark, a lot of economic clues we might get today, but at the moment, this is a market that's trying to figure out how much tightening will result from the run on the banks we saw over the past month. How are you thinking about that?
Well, I think, specifically on the banks and monetary policy, what we've seen globally is the governments and the policymakers really trying to split these two things and saying we have, really aggressive policies to deal with any issues in the banking sector. And we have aggressive policies that are separate on the monetary side, i.e. hiking rates, to deal with inflation. And so far, they've been kept separate. And as you've said, the equity markets, have taken a very benign view of what's happened this week. Although, of course, in the bond market and maybe in the currency market, it's been a little different.
Does it make sense to you then, or rather not does it make sense because you explain why it's happening, but can stocks continue to defy gravity? Can they continue to climb if we do have such opposing views being played out in other markets?
Well, yeah, I mean, as you say, you wouldn't see the crisis in the equity markets, but you are seeing it elsewhere. So in our view, we think that the risk reward on equities is not necessarily fantastic here, and we would increase our allocation to fixed income. And one of the reasons for that is because what we're seeing is that because of the banking issues that have happened, probably some of the smaller lenders, particularly in the United States, are going to pull back on some of the lending they do. And that's very important to credit creation in the economy. And we haven't seen that come through yet. So we think it'll come through, and it'll start to come through in earnings, particularly in banks, but also in broader measures.
Because at the moment, a lot of the concern we've seen has really, especially when it comes to hiring and cutting costs, it seems to be concentrated in tech. And Mark, the narrative there has been, well, tech just hired a lot, especially the big tech giants. But do you foresee other industries following along from that job cut, really hunkering down on cost type narrative?
Well, this is a fascinating point, and I can tell you our economists are just, up in arms about the quality of the data we're coming through and that's coming through. And, maybe the tech has been very visible because they've been announcing it and it's been being followed. But, I think we got to keep our eye on the ball here. And that is the fact that the Federal Reserve is looking at the employment statistics, it's looking at the inflation numbers, and it's putting those two together. And, although the peak for rates may be pulled forward by some of this, they're still in a mode where they're going to hike rates until they see some of that employment roll over, because historically, you've never really seen the peak of inflation until you start to get unemployment going up.
If the data is bad, and Mark, you're of course not the first person to say this, there's been lots of complaints that the quality of the data has been so hard to interpret. Given that, what do you use as your North Star to invest to try to understand the macro regime that we're in at this moment when, again, the data isn't as useful as it usually is?
Well, I think the fact that the data quality isn't necessarily there, that's one thing, and we'll maybe let some of the economists debate that. What I think we have to focus on the investment side is that for, say, 2 years, almost 3 years, the Federal Reserve said inflation was transitory, and they burned through their credibility on that. And so now they really have to look at this data, even the headline data on inflation and on unemployment, and react to that more. Because if they come in with a story now and start saying, well, the data's bad and we're going to cut rates just because, don't believe the data and we'll just start cutting rates, that they're going to blow through even more of their credibility. And so that's a little bit the dynamic we're caught in, where until you see better in a better inflation picture and better employment picture, regardless how good the data is, it's going to be very hard for the Federal Reserve, and maybe even more in the policymakers in Europe, to really start cutting rates and to lay off on this tightening.
Mark, I'm lucky enough that I almost every morning I get a note in my inbox of your view every morning. You have a fantastic one today on the dollar, and dollar strength has been a defining factor of the past year, 2 years of this market. It's upended a lot of normal trades. It's started new trades. If we are looking at a new regime of a declining dollar, what changes for you? How do you adjust to that new reality?
Well, thank you. And it's a great question, because like we were saying, if you just focus on the equity markets and not a lot going on, you're not playing the whole chessboard. And that's what's so exciting for us as investors right now, is looking at what's going on in rates and looking at what's going on in currencies. And I think there's, kind of a more short-term and a long-term perspective to take on the dollar. First, we see shorter-term dollar weakness here because we think the Fed is closer to the top of its tightening cycle than, say, what's going on in Europe. And so we would say underweight the dollar. And actually the dollar's fallen, DXY has fallen about 2.6% this month. So look to other currencies, maybe Swiss franc as a haven, maybe gold as a haven, maybe the Australian dollar as something that can go up on the China rebound.
Okay, Mark, well, we did it. We made it to Friday. We didn't break anything. I'll let you go and enjoy the rest of your day. That's Mark Haefele, Chief Investment Officer at UBS Global Wealth Management. Thanks so much for joining us. Coming up, we're going to be speaking with the Ambrosetti CEO, Valerio De Moli, live from Cernobbio in Italy. The interview's next. This is Bloomberg.
It's going to probably take us a while till we fully understand, are there more losses out there? The other thing is, what's unclear right now is how much of the banking stresses of the past few weeks is leading to a sustained credit crunch, which would then slow down the U.S. economy.
Minneapolis Fed President Neel Kashkari speaking about the impact of the collapse of Silicon Valley Bank, that as investors prepare to close out a very volatile first quarter, but one that has ended with a rise in stocks. Now, top business executives and policymakers are gathering in northern Italy for the Ambrosetti Forum. High on the agenda are those markets and the banking turmoil that's rocked them in recent weeks. Our very own Francine Lacqua is there at the forum in Chinobio and is joined by a guest. Francine.
Thank you so much, Danny. Yes, I'm about to go into a panel, but first, we're joined by the host, really, of this wonderful conference here in Chinobio on the riverbanks of Lake Como of Ambrosetti. He's Valerio De Mogli. Thank you so much, Valerio, for joining us. Now, we've had the first panel. I don't know whether there's too much optimism or too much pessimism, but there's a lot of concern, for sure, about the banks. Is the banking system sound, especially in Italy?
Yes, that's a very good question. Actually, the first panel with Nouriel Roubini, Mohamed El-Arian, Ellen Zentner, Martin Wolf, Stephen King, and the others was very, very pessimist.
With Mr. Roubini, maybe it's not surprising.
Maybe it's not unusual. Yes, exactly. That's regular. As far as the banks are concerned, the Italian banks in particular, they are very sound. Just look at their balance sheets. Just look at the risk reports of the ECB just published a few weeks ago. The stability of the European system is really sound, much better than everywhere else, and particularly than the United States. So that doesn't mean that we need to be fantastically euphoric.
Yeah,
I mean, the situation is serious. We need to be concerned and to do the right things, but it's not dramatic. Think about the 2008 crisis post-Lehman. That was really, really, really catastrophic.
And Valerio, we sat down and you said, look, we're too pessimistic. And you reminded me some of the key points. So 2008, when we felt like it was the end of the world, you also mentioned really the start of COVID, where people were extremely fearful about their future. And maybe also November, when we didn't know whether we had the energy to get through it. But what do you worry about? If you look at what we're living through, interest rates are going high. They've been high, for a not long amount of time. They got high very quickly. What will break next?
Yes, well, that's a very possible question to answer. As I said in my introductory remarks here at the European House Ambrosetti Finance Workshop, we are living an era that I define the perma-crisis storm. No. We have several worrying factors, but at least as far as Italy is concerned, we see many signs of optimism. Just to mention a few, the 2022 export of our manufacturing industry topped the historical high at 625 billion euro. The employment topped the highest figure ever reached, with 500,000 new jobs created in the country, a significant improvement with the previous year. Take few industries, the food, record exports, 60 billion, the fashion, record sales.
But also record inflation, Valerio. So it's
record
not easy.
Inflation,
I mean, there's
you're
a
right.
cost of living crisis, right?
Yes.
In a lot of countries that is not easy to live through every day.
That is true. That should worry in perspective. But it is also true that we went double-digit inflation in Europe and in Italy in particular. Now is down, not to normal at all. It's still very high, but it's decreasing. And so I do expect, as the ECB is projecting, then in 2 to 3 years we will go back to the famous 2% ceiling for inflation, which will be a sort of back to normal in a short period of time.
Do you think the ECB will have to crush the economy to get to 2%, or does it gradually adjust?
Well, I think we may have reached the top with interest rates, and there may be a gradual adjustments over time. That's my expectation.
How does Italy, if you look at the reopening of China, I know this is also the focus here, you've invited Eric Lee of Shengwei. How does Italy manage to stay close to the US, close to Europe, with maybe a bit of political questions about some of the measures put in place, but also maybe take advantage of China reopening?
Well, Italy is very much aligned with Europe, apart from a few specific points like migrants or like the automotive industry strategy. overall, we are 100% aligned with Europe. Take the Ukraine case, 100% aligned. Take the post-COVID recovery plans. So, no, I don't expect that Italy will create any problem to Europe. On the contrary, if you look at the other different governments, you have a very much bad situation in France, in Paris, with storms and protests and strikes. In London, you may not have the same protests, but you have strikes for sure.
I don't know if I can get back to London. I may have to stay here forever.
Well, why not? Well, the weather may improve, but it's not too bad anyhow. Take the example, of the German government, take Israel. So there are many issues around many nations. It's not the case for Italy. For the first time since a decade, we have a stable government.
Valerio, in this very polarized world, so you have China, US, there are proxy wars, all over the place, even within countries. As you say, France is really burning, and you have a division within the countries of two people. Do you worry about an emerging threat that we haven't really thought about yet that could also impact the economies?
It could happen, yes. It could happen because no one of the last perma-crises have been predicted. Yeah. Not the COVID, not the war in Ukraine, not the failure of the SVB in the US, not the Credit Suisse deal, nothing. So it may happen that something very bad will come up, but we need to be optimistic, and we have good elements to be, I think.
Okay, Valerio, grazie.
Thanks
so
to you.
Much
Thanks for having me with you.
There. Our host for the day. With that, Danny, I'm going to send it back to you in London, and of course, we'll bring you more interviews throughout the day.
Yeah, no, we'll come back to you in just a moment's time, Francine. Thank you so much for that great conversation, Francine Lacqua in Chernobyl. Coming up, we're going to have the latest on Donald Trump's indictment, becoming the first U.S. president to face criminal charges. This is Bloomberg. Let's get to the Bloomberg First Word News. With that is Leanne Garens. Leanne.
Morning, Danny. Finland has cleared the latest obstacle to joining NATO after Turkey's parliament unanimously voted to approve its membership. It means all 30 members now have ratified Finland's bid to join the defense alliance, which was launched after Russia's invasion of Ukraine. Neighboring Sweden's bid remains opposed by Turkey and Hungary. Now, the UK is to join an 11-nation Indo-Pacific free trade bloc, becoming the first new member since its creation. Rishi Sunak's government hopes membership of the CPTPP, which includes Australia, Japan and Canada, will boost economic growth. The UK's own projections show that joining the group will only grow GDP by 0.08%, partly due to having existing bilateral trade deals with most of the bloc's members already. The White House is pressing regulators to tighten rules for mid-sized US banks. It's calling for the reinstatement of liquidity requirements for lenders with assets between $100 and $250 billion and enhanced stress testing. U.S. Treasury Secretary Janet Yellen says loosening banking rules put in place after the 2008 financial crisis may have contributed to the recent bank failures. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Garens, and this is Bloomberg. Danny.
Leanne, thank you so much. Former President Donald Trump is expected to be arraigned as early as Tuesday after being indicted by a Manhattan grand jury. The charge relates to a case against him for directing hush money payments to an adult film star during his 2016 campaign. The Republican is the first former U.S. president to face criminal charges in a case he calls political persecution. Joining us now is Bill Ferries from Bloomberg's National Security and Foreign Policy team. Bill, what more do we know?
Well, we still don't have details of the specific charges former President Trump is expected to face, but his lawyer said he expects Trump to basically surrender himself as soon as Tuesday to the court in New York for the arraignment. That would be the time when the former president gets fingerprinted, he gets a mugshot taken, and he gets to enter a plea against the charges he's facing in a court. then he's likely to just be released on his own recognizance, and the case could drag out for months, possibly years, bleeding right into the 2024 presidential campaign.
Bill, just 30 seconds here, but are Trump's likely opponents for the Republican presidential nomination saying anything?
It's really put some of his likely opponents in a tight spot. You have former Vice President Mike Pence coming out and saying that the charges are an outrage. He's adding his voice to the criticism that this is politically motivated. And Florida Governor Ron DeSantis, another likely opponent, has said his officials would not participate in any extradition if it were required to get President Trump up to New York.
Okay, Bill, thank you very much. Bill Ferry's there from our Bloomberg Politics team. Coming up, we're going to be speaking with PIMCO Europe Global Strategist at the Embresetti Forum. French inflation slows for the first time in 3 months, but still comes in marginally hotter than expected. Eurozone CPI hits later this morning ahead of a key print from the U.S. Donald Trump has been charged with allegedly paying hush money to a porn star and will be asked to enter a plea as early as Tuesday, his lawyers say. The 45th president calls the action political persecution. Plus, China's economic recovery gathers momentum, with manufacturing, services, and construction topping forecasts in March. Good morning. Happy Friday. Welcome to Bloomberg Surveillance Early Edition. I'm Danny Berger in London. Equities really are hanging tight here to end the month, the week, and the quarter. According to Bank of America, the latest flows show that we had the most cash piles added from investors this week since March 2020. That shows you just how much of a shakeup this market has got. So why make big adjustments here at the month end? Euro, that is looking weaker this morning, down 0.3%. We did get some euro inflation, some euro area-specific country inflation. France, Germany, and Spain were yesterday. Today, we'll also get euro area inflation for the whole region. German two-year yields, those had higher by 5 basis points. For the two-year yield, it's 2 basis points. But of course, they have come in about 75 basis points over the past month as those fears of the banking sector have taken hold. Now, the 34th Ambrosetti Forum is underway today in northern Italy. Top business executives and policymakers are there discussing the outlook for the euro area. Also there discussing that very same thing is Francine Lacqua, who joins us with a guest. Francine.
Danny, thank you so much. I'm delighted to be joined by Jean Frieda from PIMCO. We're about to go on a panel together, and I heard, Jean, that the panel just now was very pessimistic. What's your take on the world economy? Will it crash?
No, I don't think we think it'll crash. We think it's fundamentally in a much healthier place than it has been, into any other cyclical downturn. The efficacy of fiscal policy, through the pandemic and the war, have really left private sector balance sheets in quite good shape. And so from that perspective, we still think that any downturn, even if it's been brought forward by the recent banking stress, is likely to be more shallow than deep.
Is there more banking stress to come?
I mean, that's very, very hard to say. What I would say is that it doesn't seem like, the U.S. has fully gotten a handle on the uncertainty around bank deposits and bank depositors, uninsured deposits. And as a result, I think everyone is on heightened alert. It is important that there is this implicit guarantee on deposits. I think policymakers have made that as clear as possible. Is that sufficient to stop the stress? Probably not. And then we start to get into business model issues with the regional banks as well. And so this is going to be a long-lasting, slow process to work through.
But, Jean, if you look at, I guess, the possible credit crunch that's coming, how much does that do the Fed's work? And so what does it mean for treasuries, and where do you want to be invested?
Yeah, so I mean, I think, regional banks account for around 25% of credit to the real economy. 75% comes from the large banks and from the non-banks. Those are still in quite healthy shape. So I think it's probably premature to say that there's a credit crunch, but certainly it's a case where the Fed has lost control of the process. We think we think the risks are sufficiently high that you do want to play it quite safe. We think you want to be, given the rise in interest rates, given the rise in bond yields, bonds offer quite attractive returns. And even the safer part of the credit spectrum, investment grade, parts of the investment grade credit universe, we think offer very attractive yield without having to take a ton of risk.
But so in treasuries, where do you want to be invested on the yield
Probably
curve?
in the belly of the curve.
Okay.
I mean, I think the story there is, you can go to cash and earn a nice yield, but you do want some potential for capital appreciation because we do think we're moving toward recession. We do think in that environment, interest rates will come down.
Jane, we also had quite a lot of stress in banking in Europe. What does that mean for countries like Italy? I mean, a lot of the banks are very dependent on, of course, their, Italian BTPs.
Right. Yeah, I mean, I think, Italy, Europe is in pretty healthy shape at the moment. I think it's sort of consistently surprised expectations on the upside. Again, fiscal policy has been remarkably effective in sort of smoothing things over for the private sector. Higher inflation has actually benefited government debt. Government debt is coming down quite steadily. We don't really see the banking stresses being nearly as pervasive in Europe as they have been in the U.S. There have been some uncertainties arising from what happened in Switzerland, but nonetheless, we don't think that's something that materially changes bank funding costs. So from that perspective, we think Europe is in relatively good shape.
I mean, we had some pretty encouraging signs from China. At the same time, there's, we could look at a real estate that's going to fall off a cliff. Like, what's the China interplay with the rest of the world, and what does that mean for, again, how you play it on the markets?
Yeah, I think the coattail effects of this recovery in China will be far less than any other Chinese recovery we've seen. It's very narrowly based. It's consumption-based. There's a lot of focus in China on sort of centralizing control and prioritizing self-sufficiency. That does not speak to a lot of lift for the rest of the world. We do think it'll help Europe at the margin. We think this is probably, the next couple of quarters are sort of peak lift from China. And then you go back to a story where China, has some struggles of its own.
Where are we in 12 months from now? Like, I don't know whether you're expecting actually cuts from the Fed this year, or whether the crunch point is in 12 months where, a lot of the monetary lag policy could come at play.
Yeah, I mean, I think our baseline scenario is one in which, the Fed embarks in some kind of opportunistic disinflation strategy, so they get to where they need to be, or where they feel they need to be, and then they stay there for an extended period of time. That said, we do think the recession risks have gone up and probably been pulled forward. So it's not in our baseline that they cut rates this year, but it's certainly not outside the realms of the possible. When you look at what the money market is pricing, we think it's pricing some kind of average of recession imminently and things being absolutely fine. So, I mean, there's still, quite a bit that can happen in the front end of the curve.
But what does a policy mistake look like from the Fed today?
I think a policy mistake is in overreacting to the financial stress, and then in hindsight, finding that there wasn't actually that much stress there in the first place. Again, I don't envy them the task. It's not an easy job, but ultimately, we've got a two-front war between inflation and financial instability, and the Fed needs to keep its eye on the inflation price.
But how difficult is it to entangle those two?
Extremely, extremely.
And so, I mean, does extra regulation on banks help, or is it extra supervision of the rules that are already in place?
Extra regulation is something for the future. I mean, it may happen now, but it's something that impacts the banks over a longer period of time. I think the immediate prerogative is to try to use macroprudential policy and at some level potentially the balance sheet to stabilize the situation, the uncertainty on the deposit side, so that the Fed can focus on this inflation battle.
Talk to me about the UK a little bit. So it certainly wasn't dull in the fixed income space over the last 12 months. Is it now more stable?
I think it's much more stable now, but I would say that the LDI crisis was kind of it revealed the canary in the coal mine of bonds not serving their traditional role in portfolios as a safe asset. This is similar to what happened with SVB, and we may see more instances of it. But as far as the UK goes, I think the challenge there is really they're kind of like the average of Europe and the US. They have a labor market that is structurally very tight. I think in the best case, the Bank of England will be able to stop relatively soon, but it's going to have to keep rates high for quite some time, given the underlying inflation pressures there.
Are you buying gilts?
Are we buying gilts? Well, we don't comment directly on what we're doing in our portfolios.
But it's not. I mean, is it a bad play? Is it a good play? Like at the moment, does it look attractive?
I would say it's not. It's probably not one of our favorite markets. I think we do find more attraction in the U.S. because we do see the disinflation process is much more advanced and convincing. Yeah. Whereas in the UK, we're looking at something closer to stagflation risk.
Okay, Jean, as always, thank you so much for joining us. Jean Frieda there from PIMCO. Danny, with that, I'm going to send it back to you in London, and of course, we'll have plenty more from Ambrosetti throughout the day.
Francine, thank you very much. Again, Francine Lacqua there with the PIMCO Executive VP and Global Strategist. Now, stay with Bloomberg Television throughout the day. We're going to bring you more conversations, as Francine said, from the Ambrosetti Forum. She's going to be sitting down with Nouriel Roubini in Chernobyl. That interview is coming up in less than an hour here on Bloomberg Surveillance. But first, coming up on this program, the UK is going to join an 11-nation Indo-Pacific trade bloc. We'll bring you what membership will mean for the UK economy next. This is Bloomberg.
With the UK joining, we're going to be the second biggest economy within the CPTPP group, and it turns it from a Pacific agreement into a global agreement of countries that are hugely motivated to retain and advance free, open and fair trade.
British High Commissioner to Singapore, Cara Owen there. The UK is set to join an 11-nation Indo-Pacific free trade bloc, becoming the first new member since its creation. Rishi Sunak's government sees membership of the CPTPP, which includes Austria, Japan, and Canada, as a boost for economic growth. The UK's own projections show that joining the group will only grow GDP by 0.08%. So not too much there. Joining us now is Bloomberg's UK politics reporter Yellen Milligan. Yellen, membership of this group, I mean, it's only contributing to less than 0.1%. So what does the government hope to get from this?
And by the way, that 0.08% is actually will come in annually after 10 years of being a member. So it's not even an immediate economic benefit. And when you put that into the context of the 4% economic hit projected from leaving the European Union, it does look pretty measly. But it's not comparable to being a member of the EU. This bloc doesn't have its own laws. It doesn't have a court or parliament. It's essentially a multi-country trade agreement, rather than something comparable to a bloc like the European Union. So what the UK says is that this is not a deal for today, this is a deal for tomorrow. More countries are going to join. They point to Thailand and South Korea. The Indo-Pacific region is going to be the big growth economy over the coming decades. And they also see this as important for the UK's soft power in the Indo-Pacific. They've, in recent years, wanted to tilt from Europe to the Indo-Pacific. You've seen Rishi Sunak do defence deals recently with Japan and Australia, two of the most prominent countries in this trading bloc. And the UK will be able to have a say over trading rules going forward for the region, and also, quite crucially, it will be able to veto any new members. Now, who put a application in to join the CPTPP 2 years ago? China, and that's really interesting because the UK is very conscious of now having a role in the say over whether they get membership.
Ellen, you say CPTPP like it's easy and it rolls off the tongue. I struggle with that acronym. Look, while we're talking about UK growth, we also had fourth quarter GDP data this morning. What were some of your key takeaways from that?
Well, yeah, the UK economy grew by 0.1% in the last quarter, narrowly avoiding a recession. It's quite hard to celebrate this as an economic win, considering they only just dodged a recession last year. There was a number of really interesting economic data out today. House prices fell at their sharpest annual rate since 2009, since the aftermath of the 2008 crash. That's obviously linked to high interest rates, people being reluctant to take out expensive mortgages to buy new homes. But on the flip side of this, actually something that I think is really interesting that hasn't had loads of pickup today, which is that the UK's national living wage, which is the hourly wage set for workers who work per hour, like in shops or part-time, will rise from tomorrow by 9.7%. That's really interesting because it almost matches inflation hovering at about 10%. But when you compare it to the annual wages of public sector workers, which are going up by about 4%, and of course there's lots of industrial action and strikes that have been taking place because of that. It's really interesting context, especially as the Low Pay Commission, who advises the government on this, says that this won't be inflationary.
Right. Ellen, thank you very much. That's Bloomberg's Ellen Milligan. Thanks so much for joining us. And we're going to be covering all things UK every week on Thursdays. It'll be at 9:30 a.m. London time in our half-hour special. Or from the UK to China, where the economy kept up its momentum in March with the non-manufacturing PMI soaring past expectations to an almost 12-year high. Joining us now is Bloomberg's Tom McKenzie. Tom, I thought we knew China was recovering well. So why are these reports so much better than what was expected by economists?
Well, I think there was an expectation that China was going to recover well as it reopened, and that surprise reopening, of course, towards the end of last year. But there was all sorts of questions about to what extent COVID and the spread there was going to derail things in terms of manufacturing, in terms of keeping people at home. But what we're seeing is that in terms of that demand around consumption and travel and buying in shops and restaurants, that has ticked up pretty strongly. So across the non-manufacturing PMI, so construction and services, as you say, the print came in at 58.1. So levels that we last saw, that's the highest print since May of 2011. Manufacturing PMI as well for the month of March also came in higher than forecast, 52. So comfortably above that line in terms of expansion, 50 and above. What is happening is local governments are spending more. They're giving incentives for people to get out and spend. And that is having an impact. And importantly, it's domestic consumption that is the play. And that's what the government wanted to see. They've wanted to see people go out and consume. And so far, that is holding up. We've heard from the new Premier of China, Li Qiang, speaking to foreign executives in China this week and appealing to them, saying you can invest, you can have faith that the economy is rebounding here. A couple of points to note. Unemployment remains a challenge, particularly for those under the age of 25. So continue to watch that, because if that becomes and continues to be a problem, then consumption could start to ebb off again. And manufacturing as well. Sentiment there is pretty weak. Exports remain pretty weak. And of course, if we get into a recessionary environment, and many predict out of the US and Europe, of course, major trading partners for China, then that could prove a further drag on exports. So those are potential weak spots. But at the top line, in terms of the domestic consumption, that is rebounding very strongly. And it gets them onto that track for 5.3%, which is what most economists think they're going to get in terms of the economic growth this year.
Well, I've got to imagine that appeal to say, hey, invest in China. Yeah. Part of the story also must be that our environment for tech is okay. There's been a lot of attention around the reopening of China's tech IPO market. What has that meant for sentiment?
Yeah, so to your point, the Premier's words at the Boao Forum in Hainan, backed by the economic data, now backed by some policy changes. And you're absolutely right. Look, we were whiplashed by the changes around the regulations confronting the tech sector in the last 2 years. And now, just in the space of a week, some really major advancements in terms of easing back. You've had Jack Ma, arguably the most high-profile Chinese business executive, back in China. We've had Alibaba, of course, the major e-commerce giant, announcing it's splitting into 6 parts. And then today, reporting from Bloomberg, they are now approaching IPOs for the logistics business. That's worth about 20 billion. It's called Cainiao. And then JD.com, one of their big competitors, is also looking at an IPO. So they're looking to extract value. And clearly, they would not be doing this, these companies, if they didn't have the blessing of the Communist Party and the government.
Yeah, certainly not. Maybe serves as a blueprint for all other large China tech. Tom, thank you so much. It's Bloomberg's Tom McKenzie. Now let's get to your Bloomberg Business Flash. With that is Leanne Gerrans. Good morning, Leanne.
Morning, Danny. Netflix is restructuring its film group to make fewer movies and centralised decision-making. The US streaming giant says it will combine units that produce small and mid-sized pictures, resulting in a handful of layoffs. Netflix has released more original movies than any other company in Hollywood recently, producing upwards of 50 projects a year. Now, Tesla is said to be looking to build a battery plant in the US with China's CATL. Sources say Tesla discussed plans with the world's largest EV battery maker and the White House in recent days. We're told Musk's company wants a similar deal to the one agreed by Ford and CATL, who are building a factory in Michigan, wholly owned by the US car maker. Now, China's biggest state-owned banks have delivered full-year profit gains after boosting lending to help cushion the economy from strict COVID-0 policies. The lenders mostly top or did meet forecasts, with AG Bank leading profit growth at 7.4% on year. ICBC was the only major whose net income did fall short of estimates. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gerrans, and this is Bloomberg. Danny.
Leanne, thank you very much. Coming up, the White House wants to reinstate some of the banking regulations that were revoked by the Trump administration. I'll have those details for you next on Bloomberg.
These events remind us of the urgent need to complete unfinished business, to finalize post-crisis reforms, consider whether deregulation may have gone too far, and repair the cracks in the regulatory perimeter that the recent shocks have revealed.
U.S. Treasury Secretary Janet Yellen speaking at the annual National Association for Business Economics conference in Washington. The White House, at the same time, is pressing regulators to tighten rules for U.S. mid-sized banks. The package calls to bring back liquidity rules and annual stress tests for banks with assets between $100 and $250 billion. It is the strongest step yet in response to the banking crisis for the Biden administration. For more, let's bring in Bloomberg's managing editor for finance, Michael Moore. Mike, how much teeth does this actually have? Is this something the White House is going to be able to get done?
I think it's the easiest thing to get done because these processes already exist. You know, just these banks had been exempted from them. So they've already got the stress test, they've already got the liquidity rules. They've just been for the bigger banks. And so expanding them to a wider group of banks and making those banks adjust quicker to them would probably be the easiest because you don't have to create new rules.
But how much effect would it have in preventing further crises? Does it go far enough, I suppose?
I think, you know, this was a liquidity issue for a lot of these banks. And if you required them to model some of those liquidity outflows, I think it would expose some of these problems earlier on. I mean, we did have in testimony this week, you know, the Fed saying they had identified some of these issues already and were working with the bank. But if it's out there in a public stress test, it probably gets a lot more attention and the bank has to address it quicker.
Yeah, well, we also had data overnight for us late in the U.S. that banks had borrowed less from the Fed this past week.
Yep.
Is this the bank stress easing?
It's easing a bit, but those are still quite elevated numbers. And you've seen a shift from the typical discount window into this new program that has a little more term to it. So, you know, if banks are able to lock in a little bit longer term loans from the Fed, perhaps gives them a little more comfort not to have to tap it as often. So I think you're seeing a bit of easing, but not back to normal yet.
Right. All right. At least it's better. At this point, that's the most we can ask for. Michael, thank you so much. That's Bloomberg's Michael Moore. Now, don't forget, we're also going to be getting U.S. PCE data later. That's the Fed's favorite gauge of inflation. Markets at a standstill until then. This is Bloomberg.
The banking concerns might be behind us because regulators have been extremely fast and extremely determined in addressing them.
The good news is the flashing red is behind us, but we're now in the flashing yellow phase.
The main issue remains unaddressed, which is there's going to be a growth price to pay for the fact that you've raised interest rates by almost 500 basis points over the past year.
The actual impact of rate hikes really trickling through into the real economy and accidents happening as a consequence of that, those are concerning.
It takes a time for this tightening of credit conditions to feed through into weaker growth. Once it does, the equity market will react.
This is Bloomberg Surveillance, early edition, with Anna Edwards and Matt Miller.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. For the first time ever, a former U.S. president faces criminal charges. A grand jury indicts Donald Trump in a case that could reshape the political landscape. The economist known as Dr. Doom talks about mega threats and how to survive them. We will hear from Nouriel Roubini. And we'll look at the euro area inflation data that's just hitting the Bloomberg now and preview a key US inflation gauge. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. And Matt, clearly the focus of the news cycle very much on US politics. In the meantime, the markets perhaps take a breather after what we've seen.
Yeah, well, I mean, the political story was an absolute bombshell dropping last night and confirmed by the prosecutor here in New York. We'll talk about the Trump indictment throughout the program and throughout the day, if not throughout, the rest of the year, because this has real implications for the 2024 election. In terms of the markets, we have had a pretty good month and a pretty good quarter. S&P futures are still up, but only, as you can see, 0.04%. You do have investors letting go of 10-year bonds, the yield floating up to 356. This is about where it was actually yesterday when we looked at it. But if you see the charts, you'll see the 10-year yield coming up. You'll see the Bloomberg Dollar Index coming up. You don't see that for crude, and you don't see that for Bitcoin. NYMEX down to 73.87, so back under $74, and Bitcoin back under 28,000 at 27,822. We did see a lift out of Asia. If you take a look at Asian markets, you'll see that we had gains overnight. The MSCI Asia Pacific up another 0.5%, with the Hang Seng gaining the same, and the Nikkei up 1%. The dollar gaining some strength. Really, you saw it against Bitcoin. You'll see it against other currencies, but against the yen as well at 133.43. So a little bit of a lift there, although the Bloomberg Dollar Index still holding at, I think, about 1229. Take a look at though, the dollar strength today. If we see it really start to pick up, that could be a headwind for stocks. If you see rates continue to rise, that could be a headwind for stocks as well. Anna, what do you see in Europe?
Yeah, let's get straight to some breaking news coming through on the Eurozone and on the inflation beat then. Euro area March consumer prices rising by 6.9%, Matt. That's the year-on-year figure. It's a big step down from the previous month, and it's lower than the estimate. So on both of those fronts, inflation at the headline level at least moving perhaps in the right direction for policymakers and for everybody who wants to see the back of some of the higher readings of inflation. There are still questions around core inflation, although I note that in this set of data, core has come in line with estimates. So we'll continue those conversations about where the Eurozone inflation story goes and indeed where we go stateside. Later on, we get PCE. We had the map up for a moment. It showed a mixed picture for Europe, and that's what we've got, mixed picture for stocks. Here's euro dollar, 108.78. We see a bit of weakness in the euro this morning, a bit of strength in the dollar. Maybe that's more in the driving seat, though. Dollar strength around risk-taking rather than a recovery from the financial crisis, from the sort of financial turmoil we've seen over recent weeks, rather than being driven by the Eurozone data. Here's the pound, also on the back foot then, 123.64. Again, probably being driven by the dollar this morning. But we have had some interesting data out on the UK. GDP revised up just at the margins, but still confirmation that we avoided that recession for now that a lot of people are talking about. But negative news flow surrounding the housing market in the UK, and that has an influence on the psyche and the economy. Air France KLM, one of the aviation stocks in focus, Matt, moving higher. We've seen upgrades to various names in the sector from the likes of Barclays and Deutsche Bank. So that's having an impact on those that operate in the aviation space. And the banking sector, just keeping an eye on that as it is Friday. And this time last week, we were focused on a big sell-off across European stocks and the banking sector as nobody wanted to hang on to that risk as we went into the weekend. Today looks a little bit different, just some gradual moves lower, but it is the worst performing sector here in Europe, Matt.
All right, well, we'll continue to watch that, and there's a lot of movers related to it. Right now, though, I want to get back to the big political story. For the first time in U.S. history, a former president has been indicted. Donald Trump's lawyer says he is expected to be arraigned on charges as early as Tuesday. A grand jury in Manhattan decided there was enough evidence to proceed with a case against him for directing hush money payments to a porn star during his 2016 campaign. Former Vice President Mike Pence spoke about this with CNN after the announcement.
I think this is an outrage, but I also think at a time when the American people are struggling so much that this will only further serve to divide our country. The message that this sends to the wider world is a terrible message about the American justice system. And I would that this Manhattan DA would have thought better of it and put the interest of the nation first.
Emily Wilkins, Bloomberg government reporter, and Bill Ferries, our former U.S. national security team leader in Washington, join us for more. And Emily, let me start with you. Is this a lose-lose situation? Is there anything positive that comes from this?
Well, if you're Donald Trump and you are keeping an eye on getting that Republican presidential nomination from the Republican Party, this could actually be a good thing for you. We have seen in polling again and again that Republican voters, they just don't think that these charges are serious. They think they're politically motivated. You've seen Trump go ahead and fundraise off of this. And you've also seen others who are running against him for president come out and actually support him and really sort of say, you know, that these charges should not be there. And I think to a certain extent that does help him a little bit politically. The question, of course, is exactly how much, because if you just stop looking at the Republican voters and you take the wider swath of voters, the Democrats and the independents, you see much smaller percentages of everyone thinking that this is politically motivated. So if he does wind up being the Republican nominee, this could hurt him in the general. I think we still have a lot of questions, though. We have yet to see exactly what the charges are. We don't really know at this point the details of exactly how Trump might go ahead and surrender. And of course, remember, we have other pending investigations, both in Georgia and here in D.C., and that could absolutely play a role into what happens.
All right, so maybe good for Trump, but how bad is this for the United States of America, Bill? I mean, the president himself, the former president himself, has forecast death and destruction if he was indicted. And we are already worried about security threats here in New York City.
Right. It's certainly going to add fuel to a very polarized and tense climate in the U.S. politically. We know the court in New York, where the president is expected to be arraigned as soon as Tuesday, has already been beefing up security. That's going to continue until the president appears there. Listen, the United States has never seen a former president with a mugshot getting fingerprinted and having to stand in a court to answer to charges against him. That's all likely to happen as soon as Tuesday next week. As Emily said, I think at many levels this will help rally the president's base, his core supporters. The big question is going to be some of those more centrist Republicans, some of those independent voters. Do they agree with the former president that this is a bit of a witch hunt, a political use of the legal system, or do they see this as too much drama, a bit of coming back from a period that they thought the U.S. was moving beyond?
Emily, do we get any clues yet? And we heard a little bit from Mike Pence there, but do we get any clues yet as to how the Republican Party is going to fall on this particular subject, whether they're supporters of Trump or not, how they view this, how much distance they want to put themselves between themselves and him, or how close they want to be to this?
Well, for weeks now, you've been able to see Republicans really begin to formulate their responses to this indictment. We knew that this was coming. And what you've really heard, particularly from Republicans on Capitol Hill, is that entire thing is politicized, that they are simply going after Trump to go after Trump, and that this is absolutely outrageous. That was actually the one-word statement from Judiciary Chairman Jordan, who leads the Weaponization Committee, looking into the potential weaponization of government. So Republicans have really kind of made the fine point here that you ask them about this and they will immediately pivot to Manhattan DA Alvin Bragg. They will immediately begin talking about the politicization of this. To a certain extent, Republicans know that Trump has not done well in previous elections in key swing states in 2022 and, of course, with the presidential in 2020. And I think to a certain extent, there is a kind of narrow line that they want to walk, where they don't want to talk so much about Trump as so much about the larger situation and whether or not Alvin Bragg and Democrats are doing the right thing here.
Yes, Bill, this isn't the only legal challenge that the former president could face. What are the other challenges he faces?
Right. Regardless of how this plays out, he's got a slew of other legal challenges coming ahead. You have a case in Georgia where the prosecutor or the district attorney has to decide whether to press charges accusing Trump of meddling in the publication of results from the 2020 election. He faces a lawsuit in New York State. He and his children face a lawsuit over whether they manipulated the values of some of their properties. That could actually be financially the most damaging case for the president if it goes forward. Listen, there are probes into Trump's possible incitement of the January 6 protesters. There's an investigation of his handling of classified material found at Mar-a-Lago. So really, however this plays out, there could be other indictments or legal setbacks coming ahead for the president. All of that will bleed well into the Republican primaries and the 2024 presidential race.
How have we heard, Emily, the Biden administration responding to this, if at all? You know, does Biden want to get involved? Is there any way they can bring attention away from this? Have they maybe called Alvin Bragg and said, "What the heck are you doing?"
I think to a certain extent, the Biden administration has tried to keep out of it. I'm sure, of course, as today goes on, we will be hearing some more from the Biden administration. But to a certain extent, they have really tried to separate themselves from this process, saying, hey, that's the judiciary. We're going to let that process play out. Remember, as much as we are talking about Alvin Bragg, this was a grand jury that wound up deciding on this indictment. So it wasn't simply one individual acting alone. And to a certain extent, Biden's tried to be very, very careful about not getting too involved, not putting his finger on the scale, not trying to tip anything one way or the other at this point.
Okay, Emily, thanks very much. Thanks for joining us, Emily Wilkins, and also Bill Farries, with lots of analysis of what's going on right now. We'll have more on Trump's indictment later this hour. We'll speak with Peter Trubowitz, International Relations Professor at the LSE. Also coming up, we will talk to Zeynep Ozturk-Unlu, Deutsche Bank's private bank EMEA CIO. We've had that inflation data out from Europe. What does she make of the sustainability of those moves lower? And renowned economist Nouriel Roubini joins us. He joins us live from the Ambrosetti Forum in Cernobbio by the side of Lake Como in Italy, where we've been hearing from an array of experts on the global economy and markets. Earlier, Bloomberg Opinion's Mohamed El-Erian discussed the recent turmoil in the banking sector.
This is not 2008. 2008 was a sudden stop, where things just stopped because the payments and settlement system was in play. This is very different. This will play out probably in the third and fourth quarter, and it will have a long tail. So it is very, very different from what we've experienced before.
Welcome back to Bloomberg Surveillance Early Edition. Now, we started the programme with some data out from the Eurozone showing what we'd expected, a drop down in the inflation narrative in the Eurozone, a real step down. We saw that in Spain yesterday, we saw it in Germany yesterday, and now we're seeing it at the Eurozone level as well. So that moving in the right direction as far as policymakers are concerned. A slight tick up, though, in the core CPI reading year on year. Let's work out what this means for investment strategy, for central banking, and we'll speak to Zeynep Ozturk-Unlu, who's Deutsche Bank Private Bank's EMEA CIO. Very nice to have you with us, Zeynep. Let's start with this inflation story then, because on the one hand, we can all cheer a 3% inflation handle in Spain and look at this big drop down and say, well, that's a bit of a relief, really, for lots of European economies. But the core numbers do look sticky. Does this add to your thinking about how long inflation stays elevated?
To be fair, it's quite in line with what we were expecting. We were expecting the core to come down much slowly than the headline, and especially with the core data that come from food, transport and shelter, one of the core items that impacts everyone's day-to-day life, and where the central banks have been focusing on. This is a worry broadly that you want to see that coming down much quicker, but this is how the data feeds in. This is how you see the actual impact of the rate hike. So it takes time, and it's not unexpected in a way.
And a lot of people have been talking in recent weeks about just how much the ECB might continue to hike, and maybe the Fed a little bit less so with the financial turmoil that we've seen, and that could lead to euro strength. But there's quite a lot of crowded voices maybe giving that call. Are you concerned that that's kind of crowded, or do you share those views?
I don't think it is crowded to a certain extent, but I don't think it is wrong because ECB was very adamant in the way that they were messaging their fight with inflation. Of course, some of the turmoil that we've experienced last couple of weeks have created the question mark whether they will continue or they will be a bit more slow. But now this gives ECBs a strong hand in terms of confirming that their actions have been right and they need to focus on their rate hike, but it can help them to be a little bit more slower or a bit less hawkish. So in a way, this is a good sign.
Does the ECB have to worry about financial stability as much as the Fed does?
I don't think so, mainly because of the fact that the European banking system have been significantly more regulated. And if you look into different parts of Eurozone, you have seen the main whirlwind effects have been quite strong in terms of the sell-off in bank stocks. But when you look at the fundamentals, they are much strong and the system has been significantly more regulated. That's why even though ECB gave a very positive support to the system, they are not as worried or are not as concerned like the situation that we see in US.
So here the problem has been obviously rising rates means the value of Treasury holdings is lower than a lot of people would have expected a year ago. Plus, we're starting to worry about commercial real estate. Are those two issues not at play for European banks, for the European economy?
If I start with the first one, the rising rates is an issue broadly for the industry in general, but it has also has its positive impact in the positive margins that you get from a higher interest rates within the banking sector. And this was one of the positive calls that a lot of the industry experts were giving on banks' performance. But when it comes into move away from the deposit size or the deposit run, as we call it, happens, this creates this mismatch. However, in Europe, we haven't seen anything in that scale that has been the case in US. Plus, the way that the deposit percentages and the collateral of the long-term treasuries is significantly less in Europe. So it's a much better place for the European banks. When it comes into the commercial real estate, of course, it's a major worry across the board, regardless Europe and US. It's more around how banks have been working around their loan to values or how they have been taking the risk. What are the measures that they had becomes more critical. So it's not just region to region, but it's literally bank to bank that one needs to look through.
Okay, so that's the focus there. In terms of the broad stock market picture, global stocks actually have had a pretty good time of it in the last, when you disregard the turmoil around the banking sector. But if you look at how it's performed over the last quarter, we've seen the second straight quarterly gain actually for global stocks. Tech stocks clearly to the fore, rallying an incredible amount even before we see a pause, even if we have seen a step down from the Fed. Do you buy into further momentum behind tech?
Not really.
You prefer elsewhere?
Yes, no, we are very balanced, and I think this was the name of the game for us since the beginning of the year, to be quite balanced and diversified across. Our main view was to go with more value rather than growth, but now what we have seen is growth is overtaking value because of the concerns. But when you look into the sell-off that we've experienced over the last couple of weeks, the impact is not as much in the broader index than, for example, what we experienced in the tech sell-off back in last year, because of the percentage of, for example, financial sector within the broader index is significantly lesser. Therefore, we still think that our call on more resilient market holds. We're not increasing or decreasing, in a way, our exposure. So I think this is going to be a more or less very diversified regionally and sectoral view in our equity exposure.
So Zeynep, we covered the banks, we've covered tech. Anna and I have been talking a lot about retail lately, with a lot of retailers working off inventory. How is your view of the consumer in Europe, and what industry groups do you like?
This is one of the most tricky questions I have to say for today, because the consumer sentiment in Europe is still not great. But when we look into the luxury in particular, that part gets the best return and performance. And what we connect it with is mostly the reopening of China and the flow that we see coming into with an increased tourism, not only from China, but broadly from the Asia into Europe, and the way that we see some of the undervaluation of the property in UK, for example, that you start to see US investors and the Chinese investors coming in and seeing whether this is something that they can take advantage to. But overall, the local consumer sentiment is still relatively negative because of the increased prices are impacting everyone's day-to-day life, and increased rates are impacting the mortgage cost. So what you really see is the higher end of the consumer products. Luxury goods are the ones that are performing quite well.
We continue to see that bifurcation, that wealth inequality. Zeynep, thank you so much for joining us. Zeynep Ozturk-Unlu of Deutsche Private Bank, talking to us about the economy and really the markets here. Let's keep you up to date with the first word, with the news from around the world. Here's your first word news. In China, the economic recovery that Zeynep mentioned picked up steam in March. Gauges for manufacturing, services, and construction activity remain strong. That boosted the outlook for growth this year. The Purchasing Managers Index for the non-manufacturing sector reached its highest level since May of 2011. The White House is taking its strongest step yet in response to the banking crisis. It's pressing regulators to tighten the rules for mid-sized banks following the collapse of two regional lenders. The White House says that deregulation of the banking industry went too far, although I spoke with Barney Frank, the co-author of the Dodd-Frank bill, and he said he didn't think that was the case. Finland has cleared the final obstacle to joining NATO. Lawmakers in Turkey unanimously voted Thursday to ratify Finland's entry into the military alliance. The vote seals a major change in the European security architecture. Finland and Sweden sought NATO membership following Russia's invasion of Ukraine. Turkey and Hungary still oppose Sweden's entry. The UK is joining an Indo-Pacific trade bloc in a major post-Brexit agreement. The 11-nation Comprehensive and Progressive Agreement for Trans-Pacific Partnership includes Australia, Japan, and Canada. Prime Minister Rishi Sunak's government sees growth of $2.2 billion each year over the long term, and that could grow if others join the bloc. Bloomberg has learned that Tesla is looking to build a battery plant right here in the US of A, and it would likely be a controversial arrangement with China's dominant electric vehicle manufacturer. In recent days, Tesla discussed plans involving the company CATL with White House officials. So Tesla remains, I guess, in the news with that, and global car makers continue to make that push towards EVs. I don't know if you saw, Anna, but Lamborghini announced the successor to the Aventador yesterday. It's a hybrid, a V12 engine, but also with battery-powered electric motors that generates over 1,000 horsepower. And I'm very much looking forward to seeing it next week when they bring it to New York for the auto show.
I'll add one to my shopping list. I'll focus very much on the politics, of course, Matt. But meanwhile, markets actually recovering a little bit. European stocks ticking up a little. The Chinese data reassuring, and perhaps because we don't have any banks collapsing, not loudly anyway, right now, this Friday morning. And that's adding to some optimism.
Yeah, absolutely. We're going to talk about that as well with someone who's not optimistic at all.
Yes.
Coming up live from the Ambrosetti Forum in Cernobbio, Italy, Nouriel Roubini, Roubini Macro Associates CEO, also known as Dr. Doom. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. For the first time ever, a former U.S. president faces criminal charges. A grand jury indicts Donald Trump in a case that could reshape the political landscape. The economist known as Dr. Doom talks about mega threats and how to survive them. We will hear from Nouriel Roubini. And euro area inflation plunges by the most on record, but underlying price gains hit a new high. We'll get a key read on US inflation later today. I'm Anna Edwards in London with Matt Miller in New York, and I suppose it's the inflation dynamic that we've seen in Europe here that will feature on the US market radar later today, even if all of the headlines and the news cycle is dominated by politics then, Matt.
Yeah, I mean, we're absolutely focused on what looks like an historic case, the first time ever that a former president faces criminal charges. He'll be arraigned and fingerprinted. Normal procedure would be handcuffs, but I'm sure they'll leave that out. And it threatens to further divide an already incredibly polarized country. Now, none of that looks like it has any effect on market assets or prices so far today. Take a look what's going on here in futures. We continue to gain after a positive finish yesterday. We've had a positive March and a positive first quarter as well. Remember, today's the last day of the week, the month, and the quarter. So looking at gains here, maybe a little bit of window dressing. Investment managers need to show their clients that they're putting that money to work. And also a little bit of momentum. You mentioned the tech stocks, and they have done very well. In fact, if you take a look at the biggest tech stocks, they're responsible for 160% of the S&P's gain so far to date. So we do see the 10-year yield, I guess, climbing a little bit, but really unchanged, right? 355 is the level there. We've seen that over the last couple of days. NYMEX crude also not much changed at 74.40, and Bitcoin, although it's down $300, it's only just below 28,000. So that kind of resilience has been really incredible to watch, although in a very thin liquidity market. In terms of pre-market movers, there are a lot of big individual stories out there. Virgin Orbit Holdings down 50%. This is the company, the satellite launching company tied to Richard Branson. It is ceasing operations indefinitely, succumbing to growing cash crunch pressures that have paralyzed a lot of other startups in emerging technologies. This company said in a filing yesterday it was cutting 85% of its workforce in order to reduce expenses, and the remaining 15% are just going to be there to wind down the company. Las Vegas Sands gaining in the pre-market. This is really interesting because Moody's changed its outlook on Las Vegas Sands debt to a stable from a negative, and Bloomberg intelligence analysts say that hints at rising star status in the works from maybe S&P and Fitch as well. Las Vegas Sands has benefited from China lifting its zero COVID policy, pointing towards improving credit metrics and liquidity. Still, BI says this balance sheet repair, and that's something I want to talk with Nouriel Roubini about, balance sheet repair all over the place. This could still take months. And then finally, Nikola announced a $100 million offering after the close that follows a $300 million offering from Bed Bath & Beyond, and of course Virgin Orbit, and many, many companies that are just running out of cash out in the markets begging for more, but the markets don't like that, obviously, and Nikola, which is essentially a penny stock now, down 5.7%. Anna, what do you see going on in Europe?
We see increasingly positive trade in Europe this Friday. We've been pretty flat for much of this morning's session, just 2.5 hours into our European trading day. And stocks in Europe are up by 0.3%. The euro dollar is interesting, probably driven more by the dollar side of things, although that seems to be fading. And now little movement in the euro and the pound, just both of them down around 0.1% against the US dollar. On the Eurozone side, we got that inflation data, and reassuring for policymakers, it showed a decent drop down from the prior level, also below the estimates in terms of that headline print on Eurozone inflation. That comes a day after we saw a 3% handle on Spanish inflation. So things moving in the right direction, but once again, concerns that core is remaining pretty sticky, and that was again the case today. The pound down 0.1%, as I say, against the US dollar. Here we've had a mixed set of data. Yes, the GDP numbers for the fourth quarter have been revised up just very slightly. Confirmation once again we avoided that technical recession, but the housing market showing signs of weakness once more here in the UK. And Air France-KLM, I put this in, Matt, just as an example of an aviation stock. We've seen upgrades to various companies in this sector from Deutsche Bank, also from Barclays, and so as we see that, the sector flying high this morning.
All right, we'll continue to watch those high-flying airlines or plane makers as well. Right now, I want to get, though, to U.S. politics. Former President Donald Trump is expected to be arraigned as early as Tuesday after being indicted by a grand jury here in Manhattan. Back with us for more is Emily Wilkins, Bloomberg government reporter. So give us, Emily, the details as we know them on the morning after.
So there are some key things that we don't know yet, including exactly what the charges are at this point. But we know that former President Donald Trump has been indicted. Really an unprecedented moment. It will be fascinating to see exactly how this plays into his run for president in 2024. As you mentioned, Matt, we know that he is expected to be arraigned as early as next Tuesday. And we know at this point that we're seeing Republicans rally around him. Congressional Republicans, even some who have kind of sought to distance themselves from Trump a little bit, have called this a political witch hunt. They have vowed to investigate Manhattan DA Alvin Bragg. And this is really going to be very fascinating to see how it plays out just because of the unprecedented nature of it. And of course, remember, this is not the only charge that Trump potentially faces. There are also cases underway in D.C. as well as in Georgia that could wind up leading to other indictments.
And can I ask you about something else that's very politically active over in Washington right now, Emily, and that is bank regulation. We spent a lot of time talking about the turmoil in the banking sector, and now the White House flagging that tougher rules, in particular for mid-sized banks, could be in the works.
Yes, so these are banks that, like Silicon Valley, had assets between $100 billion and $250 billion. And they include reinstating some rules that were previously rolled back. These are things that deal with liquidity requirements, enhanced stress testing, and making sure that some of these banks have a so-called living will that would basically say how the banks of that size would be wound down. And this is really coming as the White House. It's their most comprehensive response at this point to Silicon Valley and the subsequent banking crisis. And it comes at a time where Congress really, it's hard to tell whether they are going to be moving on any regulations. You have Republicans pretty firmly saying across the board that they don't want additional regulations on banks. Of course, there are some questions. Could you see some other things around the edges? Could you see some transparency measures occur at this point? But it's still a little bit too early to say exactly what, if anything, really might wind up coming out of Congress.
All right, Emily, thanks very much for that. Emily Wilkins across all of it for us out of Bloomberg Government in Washington, D.C. Let's talk about the banking crisis and the resultant fallout right now. Joining us for more is an exclusive interview from the Ambrosetti Forum in Cernobbio, Italy, Nouriel Roubini. Nouriel, really appreciate your time. And this seems to be something that's incredibly elementary. Your incoming freshmen at NYU already know that when rates go up, when the yield rises, the price of the bond assets falls. Is that the simplest explanation for what happened in terms of the banking crisis here in the U.S.? And were these just idiosyncratic problems with bank managers that didn't know what they were doing?
Yes, it's a good part of it. Both bank managers, regulators, and investors forgot about duration risk and market risk. When yields are higher, the price of the bonds is lower. Investors lost 20% last year on 10-year treasuries. The S&P 500 went down only by 15%. And for the overall U.S. banks, you have about $620 billion of unrealized losses on the securities out of a capital of $2.2 trillion. And for some of the regional banks, the number are much higher. But it's not just the securities have lower value. Many of the banks had issued loans, like mortgages at fixed rates at 30%, 30 years, when interest rates were 1%, while right now they are 3.5% for 10-year treasuries. So the market value of those assets is also down. People have estimated, therefore, the overall losses for the U.S. banking system for the rise in interest rates, both on securities and loans, are equivalent to $1.8 trillion out of a capital of $2.2 trillion. Hundreds of the smaller banks are literally insolvent. So that's the fundamental problem. When interest rates go higher, the value of securities and loans is lower, and then we have mass liquidity and solvency problems.
Your recent book was called Mega Threats, 10 Dangerous Trends That Imperil Our Future, and I wonder if this is among them. Interest rates at 5% or even 6% don't seem like a mega threat. We've had rates as high as 20% in recent history in the early 80s, but we have so much more debt now than we did back then, which means carrying costs are much more painful. Is this higher rate regime a mega threat, Nouriel?
It is, because in the 1970s, when we had the stagflationary shock that led to inflation and recession, debt ratios in advanced economies were only 100% of GDP, private and public debt. Today there are 420. So we have the worst of the 70s in terms of negative supply shock, reduced growth and cause inflation, and we have debt ratios that are much higher than after the GFC crisis. And during the GFC crisis, we had the debt problem, housing debt, mortgages, bank debt, but we had negative demand shocks and a credit crunch that led to deflation, so we could do massive monetary, fiscal, and credit easing. Now we're entering a recession and financial instability, having to raise interest rates because the inflation is too high. So we get inconsistency and a trilemma. We cannot achieve price stability, maintain economic growth, have financial stability at the same time. So eventually we'll have an economic and financial crash.
I mean, central banks say they can do those two things. Good morning to you, Nouriel. They say that they can have financial stability and they can control monetary policy because they're different levers dealing with different problems. You doubt that?
Yeah, there's this separation principle that says we're going to use the interest rate policy for price stability and we're going to use liquidity to backstop the financial system and have financial stability. But that occurs only when the problems of the financial system are purely liquidity and limited to individual institutions. When you have a systemic problem and there is a risk of insolvency, and by the way, an economic recession is going to lead us from duration and market risk to credit risk, you cannot essentially lose liquidity support of the banks as a way of backstopping the system, and there's an inconsistency between price stability and financial stability. And we're headed towards a hard landing, a credit crunch, and significant amounts of losses, both for debtors that are facing much higher nominal and real rates, but also for savers and creditors, because rising interest rates reduces the market value of their creditors' assets. So you have financial instability, price instability, and economic instability.
Nouriel, you used the phrase credit crunch, and we all threw around the term credit crisis in the late 2000s. We know that that led to the financial crisis and everything that followed. How bad do you think this credit crunch gets this time around? We heard the Fed uncertain, and many voices uncertain about how much we see a pullback in the offering of credit.
Well, most of the financing to SMEs and to households in the U.S. occurs not from the large money center banks, but from these regional banks. And these regional banks are in trouble. There is deposit flight, there are uninsured deposits, there are fundamental security losses. There'll be a tightening of credit and credit standards. They have to be more cautious, they'll have to raise capital, so they're going to lend more. Credit growth is going to probably go from 10% annualized to closer to zero. And therefore, a good chunk of Main Street and Middle America is going to be subject to a significant credit crunch. That's going to exacerbate the risk of a harder landing of the real economy.
Do we have, I want to change subjects a bit, Nouriel, and talk about another threat that Steve Ratner has raised in a New York Times op-ed. He thinks working from home is a real problem for America, for American productivity, especially as Europeans and other cultures return to the office. Do you believe that it's going to be an issue if we don't get back 5 days a week? Is that going to be a problem for productivity?
Well, there are different views on it. Some people believe that the optimal situation like now, having 2 or 3 days at home, 2 or 3 days at work, is okay. Depends on the type of professions. But I think the biggest issue with the labor market right now is that we have unemployment rate very low. We have aging of population. We have the falling labor force participation rate. We have restriction to migration. We have beginning of labor strife and strikes and so on. We have the great resignation. So we have wage inflation around 6%, and people don't want to go back to work because the labor market is tight and they have now power. That means that inflation is not going to fall towards 2%, because in the service sector, the main cost of production is labor cost. And if wage inflation stays around 5–6% with the tightness of the labor market and the power that people have to stay at home, then inflation is not going to fall. And therefore, the Fed will have to hike rates much more than 5%. And if they don't do it, because they worry about an economic and financial crash, there'll be eventually a de-anchoring of inflation expectation, a wage price spiral, and we're going to end up with high inflation, recession, and the kind of stagflation like we saw in the 1970s.
Nouriel, thank you very much for joining us. Nouriel Roubini of Roubini Macro Associates, also, of course, author of the book Mega Threats. Great to have his perspective on the programme, coming to us live from Cernobio, from the Ambrosetti Forum, in northern Italy. Coming up, more on Trump's indictment with Peter Trubowitz, LSE Professor of International Relations. This is Bloomberg. This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with Boston Fed President Susan Collins. That's at 8:30 a.m. New York time. This is Bloomberg.
He's still the front runner in the Republican, amongst the field of Republicans for president. So, I think we'll see what happens. Obviously, Democrats will have to condemn him. This is something that somebody else actually already went to jail for. But how the Republicans play it out, I'm really interested in seeing the line that they're going to have to walk. The people who are with him are going to be with him, and that's not going to change.
Kristen Hahn there, partner at Rock Solutions, a bipartisan public affairs and strategic communications agency, speaking with Bloomberg yesterday after the news of Donald Trump's indictment. Trump's lawyer says he is expected to be arraigned on those charges as early as Tuesday. We still don't know exactly what those charges are. Joining us now for more is Peter Trubowitz, LSE Professor of International Relations. Professor, thank you so much for joining us. As I say, there's a lot we still don't know. But one thing that seems certain, this looks like it will further divide an already incredibly polarized America. Do you agree?
Yeah, I think in the short term. Good to be with you, Matt. Like you said, we need to wait for the details of the grand jury's decision, when that's revealed. Presumably that's next week in court. And people are rushing to judgment without the facts in front of them. But I think this much probably can be said, that domestically, the indictment will have different effects, and this speaks to the issue of division. I think it's pretty clear it'll have a rally effect among Republican primary voters. But on the other hand, and of course Democrats will condemn it, but I think it will reinforce concerns about Trump's suitability for the presidency that independents expressed in 2020 when they voted against Trump's reelection. So yes, it'll divide kind of hardcore Republicans and Democrats. The interesting group will be the independents, it seems to me, in a kind of short-term sense.
I wonder what the Democrats, what the White House thinks about this. Surely they wouldn't have wanted Alvin Bragg to go ahead with this indictment, because there are much more serious cases pending, aren't there?
There are, and I think ultimately how this plays out domestically, and we can talk about it, it has potential international implications too. I think it's going to really depend upon whether this is the first of multiple indictments, whether the prosecutors in Atlanta and the Justice Department follow with indictments in what are, more serious cases. I think most people kind of would view those as more serious cases, and one could argue here, Matt, I think that the decision taken by the Manhattan grand jury, and people need to remember, it's a grand jury, it's average Americans that took this decision, makes the possibility of further indictments greater, I think, because the precedent now has been set. This has never happened before.
Okay, so this could be the start of something then, in your view. You mentioned international implications there, Peter, and it's easy to see how this will dominate the domestic scene in the US right now, here and now, and for some of the future. But what is the international relevance of this then?
Well, I think if we follow, if it does have a rally effect within the Republican Party, which we can already see that taking place, it will reopen questions about the credibility of America's international commitments, because it will raise fears about what might happen in 2024, and that kind of Trump or another American firster will come back into office. It will stoke those concerns. I think it'll put pressure on Biden to reinforce those international commitments, at least rhetorically. And so, I mean, this is an ongoing issue for the United States internationally, the concerns about the credibility of its commitments. Of course, the administration's actions in Ukraine have reassured many, at least in Western democracies. But nevertheless, lingering in the background is the possibility in people's minds of a Trump restoration, either with Donald Trump or somebody that is echoing that America First position.
Okay, yes, I can imagine that those at NATO and many in Europe will be wondering, as you describe, overnight perhaps. Peter, thank you very much. Professor Peter Trubowitz of the LSE, thank you very much for coming to speak to us today. Coming up on Balance of Power, they will, of course, stick with this story. Mick Mulvaney, Donald Trump's former acting chief of staff, will be joining the team. That's at 5 p.m. in New York, 10 p.m. in London. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. Whilst we focus, Matt, on inflation and US politics, we don't take our eyes off what could be the next shoe. Some people say real estate.
Yeah, absolutely. I mean, we see office space, empty office space continuing to grow here. And I think this all ties into the work from home debate spurred by the stimulus we got. There's still $900 billion left on Americans' savings accounts, excess savings. And that may be why they're not coming back to the office. That's it for Early Edition. Surveillance with Tom, John, and Lisa is up next.